Hey, what's up, everyone? This is Trader Tim from over at eminimine.com doing a Monday trade recap and market analysis for the 27th of April 2020. We got a Fed meeting happening this week, and so that announcement, the meeting announcement, will come out on Wednesday. We also have GDP on Wednesday, so typically when we have a Fed meeting announcement coming out, the Tuesday before is typically slow. People are kind of waiting around for what might or might not happen as a result of the Fed meeting. So just beware, these aren't really traditional times, so it may or may not be slow tomorrow, but that's typically what we see Monday, Tuesday, kind of leading into the Fed Wednesday can be a little bit slow. After that, though, after the Fed meeting, the Thursday following, we should really see a pickup in trading activity. So whether that means we move higher or lower, I don't know the answer to that, but we should see some type of decent movement coming off of this Fed meeting announcement. Like I said, we also got GDP tomorrow, consumer confidence. Thursday, typical jobless claims, and then Friday, consumer spending. So lots of economic news. We also have earnings coming out. So if you're looking at taking individual swing trades, just make sure that you're paying attention to that earnings for that specific stock. Because you don't want to be putting on a trade and then have an earnings call that evening or even the next day. Typically, if I'm in a trade and then an earnings call is coming upon us, I will, if I'm not in positive territory, that really doesn't happen too much because I wouldn't be putting on a trade right before the earnings. So let's say I'm in a swing trade and 3 weeks go by and it's going in my favor and we got an earnings call coming up. What I would do there is typically take half off of whatever I have left, or some portion off just to reduce the risk on the trade, and then see what happens through earnings. But the idea is to not make earnings, gap against you, and then turn that winner into a loser. So let's talk about ES for today. Today was actually a pretty great morning, and I'm going to scroll back to the open, and we'll run through some of today's trades. Before I do that, the daily chart, you can see here, I took off the halfway back short just because I know it's there. So I'm still aware that we're sort of in the short, like we're between the 50 and the 61.8. But just to clean up the chart, I took that off. You can see the extension from highs to highs. We talked about a little about the extension draw in last week's video, and it's really just going from high to high as opposed to low to high because we have gone through that negative 23% target all the way up to the negative 61.8. So that gives us a failure point of the 413 low, basically a 2710 on the ES as the failure point. If this ends up being a clean double top here, and let's say we tank and we sell off, then looking for a bounce for a halfway back short would be where I would look to take that next daily swing, shorting the bounce. If we go higher from here, then our target is the 2931. Let's go down to the 15-minute. Actually, so the VIX has been dropping pretty much since our lows in the S&P. We've pretty much gone straight back down. And I went through and I looked at a lot of my trades and looked at the heat that I was taking on trades through different, volatility times. And what seems to be the common thread is I would typically on the ES be using a 1.5 point stop until we get up to, I will say a VIX 30. And then between 30 and 50, widening that stop to 2 points is really needed to stay in the trades before, giving it enough wiggle room before it gets going. And then when you're kind of 50 and above, moving to 3 points to give it a little more wiggle room, and then the ranges are going to be bigger, so your profit targets are going to be bigger. So that seems to be kind of the general guide that I'm going to use for adjusting that stop size. And right now, kind of being between that right at just above VIX of 30. 2 points has been working pretty well. It's not a hard rule, so if the VIX was at 25 and you wanted to keep that 2 point stop, that's fine. The idea is just to give yourself a little bit of wiggle room as the volatility increases. So the last month, I've been mostly looking at the 15-minute chart as my larger time frame, but with the decrease in the VIX, I've been able to kind of come back down to the 5-minute and use that, which is typically what I'm looking at as far as a higher time frame for the 512. It's either the 5 or the 15-minute, and the 5 can sometimes give you a little bit more noise. Like if we look at this general trend from today, and then I change it to the 15-minute, they're both pretty much the same. Sometimes when the volatility gets really high, if you're on a 5-minute, all of a sudden you have, a whole lot of just whipsaw moves visually in the 5-minute. So going up a time frame to the 15 can help smooth that out. So that's why I've been looking mostly at the 15 on the last month or so. But 5 minutes been really good today, and in the last week or so since we've dropped in volatility. So let's run through today's ES trades. So first we had a long setup. If we start the day, we just come from we'll take the first swing high here, high of the morning, and we start drawing our retracements up. And we take the high to low. We traded in here a little bit, not beyond 2 points. So that's another thing you can use, is just looking at the distance between the 50 and the 61.8, just to kind of get a gauge of how big that is a helpful way to gauge your stop size. I always like to leave, at least 2 ticks beyond the 61.8. And so if you're using a fixed 2 points or 3 points, just make sure that your stop, when it goes out, it's beyond the 61.8. So market opens today, nothing to do right at the open other than to kind of follow along with the drawings and with the retracements. So sold off right to the target, drew up the next one. This one failed at 61.8. We turned around, set up in the next long, traded nicely to target. So right off the bat today, for 20 minutes goes by, it's like, okay, we're starting to see some adherence to nice fib retracements. So I took the next one in the trend here, low to high, just because, we had pretty clean start to the morning as far as the retracements go. And we were gapping up as well. So next one was a low to high. Traded at a 49 and a quarter, and then that put the stop at 47 and a quarter, just about down here. Then what I like to do is, lately, again, with this volatility, using a 3-point first target has been really good. With a lower volatility, like we saw a couple months ago, I was using 2 points, but now just kind of making a small adjustment to that first target. If you're using, say, 2 contracts, you can use that first target, and the second one you can trail. So as far as the second contract goes, when the market kind of gets moving, so mostly getting moving, if it's a small 512 setup, to me getting moving means break the anchor points high. Then you can come in and start trailing each candle's low, and just trail low like that. And in this case, I ended up leaving my stop right about a 50. What was it? 50. It was 55.75. Whoops, not 55.75. That was max. 53. 28.53. So it ended up being below here, below this candle. And so it's a good way to be able to kind of lock your gains in as the move is running without capping it by having a fixed target, especially if you're within the trend. That can be helpful to get aggressive with your stop in case it runs really fast. The counter trend moves, which I'm going to talk about on the third trade here this morning, those I try to give a little bit more wiggle room because we have the potential to, fall hard because it's sort of potentially ending the trend. So we'll talk about that here in a minute. The second one was at 7:15, and we set up in a small retracement on the 5-minute here, and then after that, set up on a 512. So we established that there was some support here. We had a nice little 2-candle, kind of a hammer candle here that tagged up at the 50 and then bounced. So there was establishing support. And then on the 512, it made a nice little double bottom. That's what this 5-minute chart broken down to the 512 looks like. This double bottom broke the swing high here, and then it broke highs by a tick. A little bit riskier just because it only broke by a tick, but notice 715 and then 715 where the nicey tick was, not anywhere close to a high tick. And so that's what kind of gave me the confidence or the go ahead to go with this one. So this one I just rounded up to 52.75 and then added a tick, so 53, and then again, same thing. Once it starts to 3-point first target, and then once it starts to rip, you can come in here and just kind of give it 2 ticks behind each candle. And you can wait till it gets to the -23 and do that. So like, it breaks the swing high and then it's pretty close to the -23. But either way, just coming in and starting to, as it gets running, trailing your stop by a couple of ticks, and that will help to stay in these trades kind of for most of the momentum, for most of the move. And then the third one here ended up being counter trend because we did get a high tick. So we ran up and then we got a high tick at highs here about 5 minutes later. And so that one, we had the high tick at highs. So I just right away drew from high to the first swing low. Now this one didn't break the swing low here, but when we have a high ticket highs and when the breadth isn't extreme, like it wasn't showing extreme bullish day right out of the gate. So I kind of, 2 out of 3 in terms of looking for a swing low to break and breaking the 61.8. We broke the 61.8. We didn't break the swing low, but we did get a high tick. So taking, 2 of those 3 variables and then just drawing up the first short. This one rounding down 58.50 and then going to a 58.25. And then being more conservative with the trail on these counter trends. And what I like to do is getting in. Usually I'll still take that first target and then trailing like the high to low as it goes lower, because a lot of times you'll trade at a real small micro and then you'll set up at a bigger halfway back, something like that. But rather than, letting 5 or 10 points come back at you, and let that go, you can just trail the high to low until you hit the -23. And then when you start dropping from there, then just come in anytime you start dropping, really. Anytime you start seeing the chart just trend quickly, we're dropping like 3 points from this 56.50 down to a 50, 4. It ended up down at 53. So when you start dropping like that, then just coming in, and if you have your stop, let's say above the 61.8 here, or even above the swing high, then you can just drag it down, boom, above the candle's high. Again, just using 2 ticks above the high, drops again. And this candle doesn't break the prior one's low, so I would just leave it alone. Once we do break that low, then you can bring it down again, and then down again. And so it ends up being about a 55.25, just rounding up. And sometimes you just kind of eyeball it. If it's not exactly 2 ticks, no big deal. The idea is you're just in it as long as it's trending, as long as the momentum's with you. You can kind of see I've got the top of the first 30-minute range marked here, 55.75. We traded up to it. We saw a little bit of resistance. We broke through it, and then we kind of sat on top of it for a while. And we had a larger halfway back for the day. It kind of traded here first and rallied a little bit and then fell down. If you just left that one up, that's totally fine. Whether you used that swing high or the next one, it really doesn't make a difference. We trade up and we go through the negative 23 and up all the way to the negative 61.8 and kind of just stay in that general uptrend for the whole day. So pretty good little morning. The reason that I like to be a little more conservative on the counter trend trades is because let's say up here is where the trade took place. Let's say we fell from the top of this 30-minute range down to the bottom of the 30-minute range down here. Well, that's a pretty big ways to fall. So I'd rather not just, get out for a small 2 or 3 point gain. I'd rather try to see the momentum take us all the way to the other end, or to lows of the day and then some. Whereas, if I'm trading with the trend and we set up in a 15-minute or a 5-minute in this case, basically it's the same thing, and then we set up in a little 512, I don't want it to, come back very much. If the trend is up on the 15, the trend is up on the 5, and I get in that same trend now over here on the 512, I don't want that momentum to change on me. If I get in here at the 512, I don't want it to roll over and break my 61.8 or, start chopping around sideways at the 50% because that would be an early sign that the momentum is changing. So that's why I like to be a little more aggressive on these and just kind of trail each candle as close as I can once it breaks that swing high. So tomorrow morning we'll be doing another live trading session. You can tune in over at emoneymind.com/VIP. And if you have questions, just leave them in the comments below. Thanks and have a great week.